Let's talk 2021, look ahead, and a check-in from one of the latest BTC bulls on Wall Street. Last time we talked to Jim Paulsen, he was getting long the asset. He's back with us, the chief investment strategist at the Leuthold Group. So Jim, we're at 35K now. Let's start the conversation with the update here on crypto. Is the risk reward still favorable? I think we're probably up like 15,000 since we last spoke. I think we were talking around 20K.
Yeah. Happy New Year first, Oliver, and thanks for having me today.
Thank you.
My whole thing about using Bitcoin was not to buy and hold Bitcoin per se. I like two characteristics of it. The fact that it had low correlations to stocks and other assets, including bonds and gold, but also its extreme volatility is what I'm really trying to exploit. And what I mean by that is, what I've found is when you add that extreme volatility to a balanced portfolio with these other assets in it, if you continuously reweight the level of Bitcoin with just a little bit of it, maybe 2% in your balanced portfolio, but if you keep that weighting around that same level, then you're constantly, because of its extreme volatility, you're constantly buying and selling and taking profits all the way. If an asset is super volatile, you can benefit from buying low and selling high on a regular basis, and thereby it has negative covariance to your other assets, so your risk can come down, but at the same time you're adding incremental profitability. So I'm not as concerned about where Bitcoin is, because I'm not really a buy and hold. I'm more concerned that it maintains its two characteristics of low correlation with other assets and high volatility.
So then how are you rebalancing right now? Does the move change expectations for volatility? Has it, if you bought, let's say 2% of it, if you put 2% of your portfolio back in 20K, then obviously you'd be selling Bitcoin to keep it at 2% right now.
Absolutely, and I'd do it all the way up. I'd have some fairly tight parameters. You go at 2%. I don't, you could go 2.5, you could go 3, something like that, and I would trim and add back to that 2% weighting going forward, because it's, again, I come back to, it's not really the buy and hold Bitcoin I'm after adding profitability through trading its high vol and its low correlation with the other assets I have in the portfolio.
Okay, so you're just kind of sprinkling some in for a little zest in the portfolio. It's like cayenne pepper. It's not cumin. You can put as much cumin as you want. It's delicious. But you overdo the cayenne and suddenly you're burning your guests and stuff.
It is, Oliver. It doesn't take a lot. A few percentage, 2 to 5%, can go a long ways given how volatile this asset class is. But it can do some really good things of lowering your balanced portfolio risk while raising its expected returns.
Okay, so I think we get the plan now, how you're going to work BTC in. Walk me through the overall view, Jim. Does the outlook meaningfully change? It seems like the market is telling us that there is some real meaning behind the blue wave that looks like it's going to take place now with these double wins in Georgia. Full control of Senate means the vice president gets a tie-breaking vote. Obviously, there's some moderates, to go with the political lingo, that might prevent the most extreme, again, just kind of going with what I'm told here from the political gurus. But the idea is that right now, fiscal odds has jumped, check odds, by the president-elect's language himself now, should be a certainty that 2K checks get mailed out. What does that mean for assessing the next year? I mean, is that a big year-long impact, something that changes?
Well, I think for this year, I don't think we need more stimulus, Oliver. I really think the economy is doing pretty well on its own. The GDP now estimate for fourth quarter real GDP is 8.5% right now. And with the $900 billion package we just passed, it's going to hit first quarter disposable income. We could have explosive, maybe double-digit real GDP growth in the first quarter. I think we're going to have a year of 6% real GDP growth, maybe even a little better, which will be its fastest year of growth in over 35 years in this country. And so I'm not sure we need more. I think we're going to get more now with the blue wave, and it'll add incrementally to all those trends. I agree with that, but the real impact of that, I think, of the Democrats taking full control is not so much this year. I think this year is going to be dominated by recovery and growth as the COVID winds down and as all the stimulus with a lagged effect has big impact on not only growth, but profitability as well. But the bigger impact of this, I think, is in 2022, 2023 and beyond, where we start to deal with the latent impact of all of this massive, unprecedented stimulus. And they're just going to add more to that problem now. Those problems could be all kinds of different things, but the biggest, of course, would be even greater upward pressure on inflation down the road and interest rates, and the need to tighten more ferociously at some point in the future. I don't think that's an issue this year, but I do think it could be an issue 2022, 2023.
Jim, what do you look for to assess whether or not it does become an issue this year? Because I think we have to separate inflation from bonds a little bit, right? I mean, I know there's a whole camp of thought here. I wrote about this for our newsletter this morning, where there's a lot of people who say bonds aren't going to move unless the Fed makes them move. It's just hard for me to get along with that view when I've been watching bonds since August continue to sell off. I was joking this morning on Twitter, like, wow, this Powell presser is getting really hawkish here. Bonds are crashing. I mean, we're jumping through 1%, cutting it through it like butter right now. It's not a big level in terms of magnitude, but it is in terms of the last 10 months. I mean, it's the first time we've been here in the recovery. It seems like inflation may not be imminent, but does that necessarily mean a spike in bonds is not imminent?
I think bonds are going to have a horrible year, Oliver. I think the consensus for the 10-year yield by year end is 1.25%. I think it's going to be closer to 2% on the 10-year. I think with the data that's coming down the pipe, if we do something in the neighborhood of 8% growth in the fourth and some big number in the first, the Fed is going to be forced to stop pegging the 10-year yield. It's going to be forced to maybe not raise the funds rate, but it's going to be forced to get off the 10-year yield, maybe dial back quantitative easing. And I think there's at least a percent upside move just to catch up with where the embedded inflation expectations and tips are right now. They're about 2.05% right now. They're a full percentage point higher than the 10-year, and normally the 10-year trades higher than inflation expectations. So there's ample evidence that we got artificial rate setting going on big time. And if the Fed decides it has to back off, there's a gap upside move in bonds. Two things about that. It's bloody for bondholders. If you owned a 10-year when it was 50 basis points and now it's over 1%, you could say, well, it's only 50 basis points, but on a long duration bond, that takes a huge price hit. And if we go from 1 to 2, that's another huge price hit for bondholders. So I think bondholders are at most risk this year. And it's not just treasuries. Across the spectrum, even credit will get hit by that if we have that move. But here's the deal, I think. What I've looked at historically is when you've been below a 3% 10-year going back all the way to 1900, when yields rise, it actually boosts confidence in the economy, it boosts confidence in earnings, and stocks do phenomenal. Stocks on average, when bond yields have risen, looking at all the months since 1900, when they've been below 3%, stocks have done up at an annualized pace of about 16%. And I think that's what I'm looking at here, is it's going to have the same bloody impact on bondholders, but it's a very optimistic impact for stocks. One of the things, if you think about it, we've been worried about negative yields in the United States. We're worried about what is the message of bond yields being so low? Does it tell us we have weak growth? If alternatively yields start to go up, we're going to get more confidence that negative yields are a thing of the past. We're going to get more confidence that the economy is doing better than we thought. And we're going to develop confidence that the Fed and fiscal policies are working. All of which could raise animal spirits in the economy and aggressiveness in the stock market. So I actually look for a little higher inflation and a little higher yields this year as a positive for equity and risk taking, but a very negative for bondholders.
Jim, how specific do we have to be within the category of equity and risk taking in terms of addressing the relationship with bonds? I mean, it seems like the only explanation today for the NASDAQ being weaker would be viewing the NASDAQ as a duration asset like bonds. High valuations here that stretch back to .com levels would seem to be at risk of an interest rate spike. I mean, again, it looks like we're buying the dip in the NASDAQ, but is that going to be a problem for certain areas? Is there a magnitude that are a level on the 10-year that the high valuation stocks can tolerate up to? Is there a speed of a move that they can tolerate? I mean, what's going to be the determining factor for if certain parts of the equity group? I mean, clearly banks, totally different story than a software stock trading at 100 times earnings.
Yeah, I definitely would own some banks. Banks is the best way to short the bond market this year, and to profit from bondholders' pain. We're seeing that today. I think we'll see it all year long. I would continue to own new era tech stocks. I suspect that they're going to underperform, but I don't think they're going to collapse. Now, if you tell me that we get above 2% yields towards 3, I have more risk of collapsing in some of those companies. But I think this year, I think tech's going to way underperform small caps, cyclicals, international markets, some deep value plays, materials, industrials, some of the more cyclically tied where their profits are highly leveraged to that. But I don't think they're going to collapse. I still think their growth rate is sufficient in this world that they'll participate in the ongoing bull market. The one caveat I'd say about that is if there is a move to regulate technology in a big way, probably, again, not a 2021 issue, but maybe in 22, 23, that could be very detrimental to owning those stocks. But this year, if you're going to own Octane, which I think you should, high beta, small caps, international, you better have an offset. And the offset is not utility stocks and staples and traditional defensive investments, which I think are going to way underperform. I think the offset is technology or new era growth. Even if it underperforms, it's going to stabilize your volatility day in and day out.
Hey, Jim, what's the relationship, just quickly because we're running out of time here, but what's the relationship between economic growth, real economic growth, and yields and Bitcoin and gold? Maybe those two don't belong in the same camp, but are they duration assets? I mean, is real economic growth going to get in the way of the gold and BTC story?
I don't see much relationship with Bitcoin to much of anything, to tell you the truth, Oliver. That's one of the things I really love about it. I do see relationships of gold to things and bonds to things. I think that the growth story I'm thinking about here of explosive growth all over the world this year, both from killing COVID and declaring victory on COVID, and also from all this massive global stimulus, I think that's going to kill the gold trade. Gold is held because you're worried about weak growth, risk, and I think that people confidence is going to grow this year. And I think defensive assets, including gold, including dividend aristocrats, including low vol investing, I think those things are going to get hit hard by that overall. Gold may come back into play if inflation becomes an issue, let's say not this year, but next year. But there's other ways to play that. I think a better way to play that would be the industrial metals than I would the precious metals.
Okay, Jim, great to catch up. Thanks for the outlook here and tying the threads and drawing the dots together, trying to figure out where connects BTC, a dot on its own out there. No lines to be connected, according to Mr. Paulsen. I like it, Jim, Chief Investment Strategist at the Leuthold Group.